Welcome to the deep dive. Today we are jumping into the Q3 2025 earnings call for Titan International.
Right. And the big story here is, how they're dealing with this really deep known cyclical downturn.
Especially in U.S. agriculture. But what I found interesting is that this isn't just a survival story. It's really about how they're setting the table for, well, a pretty big rebound in 2026.
That's the perfect way to frame it. Our mission here is to get past those headline numbers and really distill what management is seeing in their core sectors: ag, earth-moving, construction.
And most importantly, what gives them the confidence to say, hey, we're at the bottom.
Exactly, and how they're positioned to, catch that upswing when it comes.
Okay, so let's start with that Q3 snapshot, because the operational performance was, frankly, pretty remarkable. Consolidated revenues came in right where they said they would.
Which is stable, right? In this kind of headwind, stable is good.
But the profitability, that's what really stood out.
Oh, absolutely. Sales were actually up 4% year over year.
Right.
And management is kind of pointing to that and saying, look, this might be the floor.
A sign that things are plateauing.
Yes. But the real mark of their operational strength was the bottom line. Adjusted EBITDA just soared. It was up 45% year over year to $30 million.
Which landed them right at the high end of their own guidance.
And that operational grit flowed directly into margins. Gross margins expanded by a solid 210 basis points, hitting 15.2%.
I mean, think about that. We're in a cyclical low, volumes are down, and they're expanding margins. That screams incredible cost control.
Cost control and a really smart product mix. It also points to something else, which is just fantastic capital discipline. They are generating a ton of cash right when everyone else is hurting.
Right. Operating cash flow was $42 million.
Which turned into $30 million in free cash flow.
So explain for us, why is generating that cash right now so strategically brilliant?
It's all about having options, strategic optionality. They took that cash, and what do? They immediately paid down debt. Net debt dropped from $391 million down to $73 million. That brought their leverage ratio down to 3.7.
So when the 2026 recovery finally kicks in and they need to ramp up production,
they won't have to go hunting for expensive financing. They've already prepped the balance sheet for growth. It just massively de-risks the entire recovery story for them.
That flexibility is a huge advantage. Now let's look at the segment sales, because this is where their whole diversification strategy really paid off. Agriculture was up 8%.
And earth-moving construction was up 7%. Both really strong year-over-year growth.
So let's dive into the ag segment first. Where did that 8% growth actually come from?
This is, for me, the core insight of the whole quarter. The growth was all volume-driven. And it was almost entirely fueled by one region.
Latin America.
Specifically Brazil. It wasn't just, a nice little offset. It was a fundamental force that completely de-risked the U.S. downturn for them in Q3.
So what's going so right in Brazil?
A perfect storm of positive factors. You've got solid global demand for grain, you've got great weather, and they're looking at record crop yields. This strength completely papered over the ongoing weakness in the U.S.
Where farmers are still struggling with low corn and soybean prices, right?
Right, which is a direct fallout from global supply gluts and all those lingering trade and tariff issues.
The margin story in ag was also just, almost unbelievable for a trough. Gross margins jumped from 9.5% last year all the way to 13.4%. How?
It's the product mix. They're not just pushing basic tires, they're selling high-value specialized components. This gets right back to that competitive moat we were talking about.
The LSWS and R14 tires.
Exactly.
Okay, so wait. For anyone listening who might not be a tire expert, what are LSWS and R14 tires, and why do they matter so much here?
Sure. Think of them as high-performance, specialized tires. LSWS stands for low sidewall technology. Basically, they let massive tractors carry heavier loads with less air pressure.
Which means less soil compaction, which is a huge deal for crop yield.
A huge deal. And R14s are a unique hybrid tire. The point is, these are not mass-produced like your car tires. They need special molds, a ton of R&D, and the manufacturing runs are smaller.
So competitors can't just easily jump in.
It's a massive barrier to entry. And because they can push these premium high-margin products even in a downturn, their margins just exploded.
That makes perfect sense. Okay, let's shift to earthmoving and construction, or EMC. Revenues, there were 145 million, up 6%.
Yeah, and the drivers here were pretty fascinating. They saw a lot of what they call drop-in orders from light construction customers in the U.S.
Meaning what exactly?
It suggests customers have run their own inventories down so low that when they get a new job, they can't wait. They need wheels and tires immediately.
Forcing them to buy right now instead of waiting.
Exactly. And on top of that, they got a nice little FX tailwind from the strong euro.
I thought the commentary on their aftermarket mining business was really interesting. They talked about their European foundry making these highly customized cast products.
That is a pure niche moat. I mean, we're talking about massive mining vehicles that need incredibly specific, heavy-duty wheels and undercarriage parts.
Not something you can buy off the shelf.
Not at all. Very few companies have the capability to produce these kinds of one-off custom parts. So by using their European foundry for this, they lock in this reliable, high-margin revenue stream that almost no one else can compete for.
And you saw that in the EMC margins, too, up to 10.4% from 8.5%.
You did.
Okay, final piece of the pie. The consumer segment. Sales were down just a little bit year over year, which they said was due to lower OEM activity.
Right, but the real story there was sequential. It rebounded 14% from Q2.
Which seems to confirm that people who put off buying smaller things are finally coming back to the market.
Yep. The deferred purchasing is returning, just like they thought it would. And that consumer segment is so important for them because it's heavily weighted towards the replacement market.
Tires for things like ATVs, boats, landscaping equipment.
Things that wear out and need replacing no matter what the big economic cycle is doing. It's much less volatile, and it provides the highest gross margins in the entire company. Came in at 23%.
Wow. Okay, let's look forward. Q4 guidance. They set revenues between 385 and 410 million, with adjusted EBITDA at 10 million.
And Q4 is always their seasonal low point, so that kind of conservatism is pretty much expected.
But there's a catch with that EBITDA number, isn't there?
There is a really crucial one. If you just look at that $10 million figure, it doesn't look like a huge jump from last year's Q4. But you have to remember, Q4 of last year had this weird, abnormal $2.6 million benefit from other income.
It wasn't operational.
It was not operational at all. So if you strip that one-time gain out to get a real apples-to-apples look,
then the underlying operational improvement in this Q4 guide is actually much, much stronger than it looks on the surface.
much stronger. The business is still improving sequentially, even at the lowest point of the year.
Okay, now for the big topic, the setup for 2026. Management kept pointing to these foundational factors that need to click into place for the ag recovery. The first one was trade policy.
This is huge. The Secretary of Agriculture, Vesant, highlighted this new agreement with China to resume buying soybeans.
A minimum of 25 million metric tons a year.
Right. But the key insight here isn't just about the price of soybeans. It's about removing uncertainty. Farmers have been holding off on buying big-ticket items because they had no idea what their income would look like in 2 years.
And this gives them a guaranteed floor, a stable revenue stream to plan against.
It's basically the green light they need to start thinking about replacing that old combine or tractor.
The second factor was monetary policy, the Fed.
Yeah, the idea that rate cuts are on the horizon is a clear positive. High interest rates have just been choking off these big capital purchases.
And the third leg of the stool is inventory, which has been the big problem all through 2025.
And it's finally getting better. Management said dealer inventories in the ag segment are coming down. They're seeing those drop-in orders we talked about. They feel like they're heading into 2026 at what they called a good neutral level.
Which means they can finally start making new stuff without having to worry about clearing out dealer lots first.
Precisely. So even though they expect OEM demand to start 2026 kind of flat, they believe all these factors will lead to a real uptick in the back half of the year.
So let's talk more about that competitive moat, because that's why this recovery story is so interesting for Titan specifically.
They have what they call a good moat, and it's really about insulating themselves from becoming a commodity.
So how do they do that?
Well, first, they're often the only domestic U.S. manufacturer for a lot of these really specialized product lines. Second, they're a one-stop shop for wheels, tires, and undercarriage components.
And that focus on the specialized tires, like the LSWS, means competitors can't easily follow them.
Exactly. I mean, if your whole business is built around churning out millions of passenger car tires, You don't want to invest all the capital needed to build these weird specialized molds for much smaller, lower volume production runs.
It's just not worth it for them.
Right, it raises that barrier to entry so high.
We also heard them talk about expanding the Goodyear brand license. What's the strategy there?
So this is really smart. It's not about just relabeling their existing tires. They're using the premium Goodyear brand to push into new high-end segments.
Like commercial turf.
Commercial turf, outdoor power equipment. It's a way to capture better margins and more market share with innovative premium products. They see that paying off in a big way through 2026 and beyond.
It all comes back to that diversification we mentioned earlier. Revenue is split pretty evenly across the three segments.
And geographically, too. I mean, we saw just how critical their Brazilian operation was this quarter. It's what allowed them to generate cash and stay so profitable during the U.S. downturn.
Before we get to our last segment, any quick notes on corporate commentary? M&A.
Yeah, they said their M&A strategy is still opportunistic. They're looking for cheap, niche businesses that fit, not chasing splashy, expensive deals.
And they seemed a little frustrated about something.
Oh, yeah, the military market.
Yeah.
They basically said they see countries like Germany moving fast to buy from their own domestic suppliers, but the U.S. government procurement process is just painfully slow. They see it as a huge missed opportunity.
That's a fascinating point of tension. Okay, time for our final segment where we connect the dots from the call to what it could mean for the market. And as always, this is not financial advice. This is just an analytical exercise.
Right. So the setup is this. Q3 was great operationally.
Yeah.
But the Q4 guidance is, seasonally soft. And it's distorted by that weird one-time item from last year.
Which could mean the stock is maybe undervalued compared to the 2026 recovery story that seems to be getting stronger.
That's the idea.
So what's the outrageous but plausible trade idea coming out of this? Where does the inflection point you're betting on?
The pitch is a long position that's laser focused on PE multiple expansion. The bet is that the 2026 ag recovery, which has been held back by high rates and trade drama, is going to show up sharply in the second half of the year.
As the China soy deal kicks in, inventories are clear and rates come down.
Exactly. You're betting that the market is still pricing Titan like it's a high-debt, low-margin company stuck at the bottom of the cycle.
And you think the market hasn't fully appreciated how much they've cleaned up the balance sheet?
That's the whole trade. The moment the market sees that cyclical surge is real, things could change fast. Because they paid down so much debt in 2025, their interest expense going forward is going to be way lower.
So when revenues jump in the recovery,
More of that money is going to fall straight to the bottom line, to net income, than it ever has in previous cycles. That means higher earnings per share projections, which forces a re-rating of the stock. The multiple has to expand. It's a bet on the speed and the efficiency of that turnaround.
a very compelling case built on all that hard work they did during the downturn.
Precisely.
Okay, to wrap things up, Titan delivered a really solid Q3. They used their aftermarket strength and geographic diversity, especially Brazil, to navigate a very tough U.S. market.
And the debt reduction and margin expansion show the company is operationally very healthy.
The key takeaway is that the focus has completely shifted. They're done just surviving 2025. Now it's all about capturing the 2026 upturn, which seems more and more likely thanks to inventory normalization and those macro tailwinds.
The stage is set.
And here's a final provocative thought for you to chew on. Given Titan's diversification, its much lower debt, and this strategic push into the higher margin Goodyear aftermarket business, if that big ag market rebound is truly lurking just around the corner, will this combination of lower costs and a better product mix allow them to capture significantly more profit on this upswing than they ever have in previous cycles? That could be what makes this time different.